This is lesson 9 of the Seido Trading Learn to Trade series. In the lesson so far, you have built a read of price, candlestick behavior, momentum, trends, consolidation patterns, higher time frame context, measured moves, levels, and you have started building a trading strategy. This lesson is about bar counting, a method of calibrating the strength of recent momentum and reading the expectations of market participants. Bar counting is useful for two things: calibrating the strength of recent momentum and reading the eagerness of market participants to push price in a given direction. It gives traders a shared language for discussing price action. When two traders are looking at the same chart, bar counting gives them a precise way to describe exactly what they're seeing. Different educators approach bar counting in different ways. What follows is the Seido methodology. As with everything in this course, clear definitions exist to remove ambiguity in execution. One important constraint before we get into it. At Seido, bar counting applies to momentum. It does not apply inside an extended trading range. Without recent momentum and inside a range, traders are responding to the boundaries, the high and the low. The focus belongs on how price is behaving at those extremes, not on counting bars. Before counting can begin, a pullback needs to be defined. A pullback is any candlestick that trades below the low of the prior candle in a bull trend, or above the high of the prior candle in a bear trend. After a pullback in a bull trend, traders are watching for the first candlestick to trade above the high of the prior candle. That's the H1, the first new high after the pullback. In a bear trend, the same logic applies in reverse. After a pullback, the first candlestick to trade below the low of the prior candle is an L1, the first candle to make a new low. Sometimes price has a subsequent pullback before it trades through the swing high. When that happens, the count continues. The next new high becomes an H2. This is the second attempt by the bulls to push price higher and through the original reference high. It is the action of price trading beyond the swing that resets the count. So in this example, when price trades through the reference high, the count resets. A subsequent pullback then creates a new H1, not an H2. An H2 only occurs when a second pullback happens before the reference high has been exceeded. An H2 is not a sign of weakness on its own, but it does tell traders something. The bulls needed 2 attempts. That's a different read to a market where every H1 is immediately pushing through the reference high. And the same applies for the bears. A second attempt to drive price lower after a second pullback is an L2. Some educators discuss H3 and L3 setups, and traders will come across this language. When a count reaches 3 or beyond, the bar count itself becomes less important than what is happening at the higher time frame. Context on the larger time frame carries more weight at that stage than any implied momentum continuation on the lower time frame. So step back, move up, and read the market cycle from there. Outside bars, where the range of the candle is larger and above the high and the low of the prior candle, are a unique case within bar counting with their own set of rules. The full treatment of outside bars is in the Price Action Mastery course. Bar counting gives traders a consistent and measurable way to read the strength of a trend. Momentum that pushes through to a new high, often H1, is strong. Bulls had relative strength compared to the bears and were able to force this new high. That's directional conviction from the bulls. When the count moves to an H2 before the high is exceeded, the momentum is weaker. This tells traders a story about where they are in the market cycle. In a strong bullish trend, traders observe a run of consecutive H1s succeeding. Each H1 pushes price to a new high. The next H1, a new high again, and then the next. That sequence tells traders the momentum is strong, and it sets up an expectation for market participants. Once that expectation is established, traders start to anticipate a new high every time an H1 forms. That anticipation is itself being traded. It creates a very defined basis not only for participation, but for reading when the trend is starting to lose strength. Because trends don't continue indefinitely, eventually an H1 is going to fail, right? The most likely place for that to happen is late in a trend, where the move is extended and the participants that are driving it are beginning to slow down. This is a 5-minute chart of the Nikkei. I've marked the H1s in pink. Price pulls back early in the morning before strong momentum appears, pushing price through the high. After the first pullback, this candle here creates the H1. Price then trades with momentum through the high. That's a successful H1. 2 further pullbacks provide successful H1s for the bulls. From this reference high here, this becomes an H1. As price did not trade to a new high before again pulling back, this candle here produces an H2. When price pulls back again before trading back to highs, traders should realize that they're in a larger consolidation period and should move to the higher time frame to gain contextual awareness. On a 15-minute chart, we see a similar pattern. Using this swing as the reference, bullish traders bought the H1. When they see clear momentum, this has already established the expectation. Traders will buy the H1, expecting a new high to develop. Everything in the earlier lessons feeds into this. The candlestick criteria from lessons 1 and 2, strong bars, momentum, gaps, the absence of wicks. Those are the individual expressions of strength. Consecutive H1 or L1 successes are the structural expression of that same strength. They belong on the same list. Markets tend to continue doing what they have been doing. That is how traders establish expectations, and it is those expectations that get traded. When a trend is producing consecutive H1 successes, traders are not just observing that, they're positioned around it. Trading is about finding statistical edge. So traders are looking for conditions where the probability of a move in one direction is meaningfully higher than in the other. That is what underpins a strategy. When traders have a defined expectation that an H1 will succeed, for example, because every prior H1 in the trend has succeeded, and the expectation is not met, those traders are disappointed. They were positioned for an outcome that didn't occur. That disappointment doesn't just disappear. It shows up in the price action that follows. This carries across all expectations in the market. Anytime a group of traders is acting on a shared expectation and the market doesn't deliver, their response becomes readable price action. Bar counting gives a particularly clear window into this behavior because the count creates a defined expectation and a defined moment when that expectation fails. A failed H1 is not just a signal that the trend may be weakening. It means there's a group of traders who expected a new high. They positioned for it and are now holding a potentially losing trade. How they respond, whether they hold, exit, or reverse their position, contributes to the price action that follows. A failed H1 can provide an L2 for the bears, and a failed L1 can provide an H2 for the bulls. So I want you to pause the video for a moment and really make sure you understand that concept. Traders on the other side are watching exactly this. They don't want to be entering an L1 in a strong bull trend or an H1 in a strong bear trend. They want to see the second attempt play out before they commit. This idea extends well beyond bar counting. Reading the expectations of market participants and what happens when those expectations turn into disappointment is a framework that applies at every stage of a move. At levels, in trends, through consolidation. The full treatment of this, including the concept of trapped traders, is covered in the mastery course in the lesson Trapped Traders and Failed Expectations. Identify clear momentum on your chart. That's where bar counting applies. Within those periods, practice counting. Find pullbacks, identify H1s and L1s, and note where the count moves to an H2 or L2. What do candlesticks look like at each stage? How did it appear on your higher time frame? Look at whether H1s and L1s on the higher time frame are more consistently respected once momentum is established compared to those on a lower time frame. This connects directly to the higher time frame work we did in lesson 6. Find periods where consecutive H1 or L1 successes are followed by a failure. Where in the trend did that failure occur? What did the candles look like leading into it? Was momentum weakening? Look at what else is visible around the count as well. We're looking for consolidation periods, trading range candles, pullbacks that go deeper than expected. Keep annotating your charts with everything you've covered in the series so far. The detail visible in price action should be increasing. More context, more connection between what each bar is communicating and the structure it sits within. That's lesson 9, and that is the Seido Trading Learn to Trade series. Across these 9 lessons, you've built a framework for reading price, candlesticks, momentum, trends, a defined strategy, consolidation, higher time frame context, measured moves, levels, and now bar counting. These are not separate tools. They are one connected read, and the longer you spend with them, the more detail you'll see. If you've made it through all 9 lessons, congratulations, and drop a comment below. I wish you the best for your trading.